and now I have a question for Larry. So Larry, in your book and all your material, you have stressed the importance of diversification, owning many different classes of stock, large cap, small cap, U.S., international, value, growth, et cetera, et cetera. And you sometimes talk about fixed income and some of these things. Now, let's say you're introducing the possibility of socially responsible investing. And I know that there are socially responsible funds, for example, that you can just buy a fund of socially responsible investments. And let's even say somebody wants close to the same return as a non-socially responsible investor. And apparently what you're saying is, hey, you can probably do that, but can you get sufficient safety through diversification, either by one of two possibilities? One, diversification within the investments of the socially responsible choices, or two, might it make sense to have a portion of your portfolio that is invested in socially responsible investments, and then the other portion not in socially responsible investments?
A lot to try to address there. We'll see if we can simplify this. So I think a good way to think about this is to begin with the important economic principle that if you are a socially responsible investor, there are two ways you could go. You could do what used to be called socially responsible, or you could now move to the ESG or sustainable strategy. Socially responsible means you're basically screening out companies. They're exclusionary factors. So you don't buy any company, maybe in tobacco, alcohol, gambling, pornography, for some people, defense, for other people, it could be whatever it is that their values are. Or, which I think is the far superior strategy, but everything is personal here. There are no right answers. But I believe the superior strategy is to focus on a best-in-class strategy. So you don't think about companies in having a good ESG score against the market as the benchmark. You think about it only in their industry. And let me point out why I think that's important, Jim. Think about the following question. Jim, if I were to ask you, which industry is creating the most green patents, so patents that will help us make the transition and battling the climate issues, what industry might you think of?
I hate to say it, but maybe oil companies are doing that.
Well, that's exactly right. It is the energy companies that are doing it. A good example is a company, a French company called Total. They have made the commitment, say, look, we're going to exploit our oil reserves that we have now. We'll drill, take those profits, and we will use those profits to make investments in more environmentally favorable products to help drive that transition. Now, if you screen out Total, you deprive them of their capital because their cost of capital would be higher, and they won't have the money to make those investments, which will drive the world to a more sustainable strategy. So what you want to do is reward the companies in every industry that are acting in the most favorable way and depriving the companies that are getting the lowest scores, rather than screening out entire industries. Now, that's my view. Somebody may feel, I don't care, I don't want to own any tobacco company. That's fine. So there are no right answers. So that's one thing. You first want to decide, do you want to use an exclusionary process, or do you want to use a best in class? The second thing you want to do is make sure you are diversified. And by the way, if you screen out entire industries, by definition, you're less diversified, right? And the economists know that the only free lunch in investing is diversification. So you're going to have a somewhat less efficient portfolio if you do screen out sectors. Think about currently now with the war in Ukraine and maybe poor fiscal and monetary policy pushing commodity prices way up. Well, while the market is down about 13% year to date, energy companies are up 45%. So you missed out on that. But if you own the more efficient energy companies in the same proportion, maybe that's, I'll make something up, 10% or 20% of your portfolio, then you would capture those returns because you still have that exposure, but only to the green company. And by the way, that's the strategy Dimensional Fund Advisors, which we think is one of the leading investment firms. We use their funds to a great degree. They have strategies that use this best-in-class approach. Now, the next thing we need to talk about is this. The academic research and empirical evidence, as we discussed, has shown that the brown or sin stocks have outperformed by, let's call it 3% a year. But then further research has found that there are simple factor exposures that explain that outperformance. Now, when we think about stocks, factors are nothing more than traits or characteristics. So you could think of growth companies versus value companies. Growth companies have high price to earnings ratios because people are willing to pay a higher price to get those higher future earnings, or at least expected. Value companies tend to have lower PEs because they tend not to be growers as fast, and they also tend to have greater risks. Okay, so value companies, because they're riskier, have higher expected returns and higher realized returns than growth stocks, despite the fact that they have lower growth rate of earnings. So all about valuations. So what the research has found is if you take your sustainable strategy and take it best in class, so you have good diversification, you could do it globally by owning a US fund, a sustainable fund, a developed markets, ex-US, and a emerging markets, and then tilt that portfolio towards these factors of small value and profitability in particular, and smaller stocks that have higher expected returns, then you can have your cake and eat it too. You capture those higher returns by exposing your portfolio to those factors, and you're expressing your values, and you're diversified. And you could do that very simply. Dimensional has 3 funds you could use: a US sustainable fund, a international sustainable fund, and an emerging market fund. And that's one good way to do it. I'll just add this point. Some people may say, Larry, that's great, but I want to screen out tobacco stocks and oil stocks, whatever, and Dimensional doesn't do that. The way we address that is we will build for you an individually tailored portfolio that meets your specific values. And the good news today, with the increased technology we have with now what's called direct indexing, you can create your own diversified portfolio, and you don't need millions of dollars to do it. Hundreds of thousands, can be sufficient. Now, it won't be as diversified, and you may not be able to tilt to these factors as efficiently as funds are able to do because you don't have the scale, but you can still achieve your goals and in terms of expressing your value. So that's kind of the 2 ways I think that investors can maximize both living their values and achieving their financial goals.